And you should probably stop following me at that point. Duh. We, as if I work for RDS, they. So today we're going to have a look at 3 stocks that are currently showing as a strong buy rating according to Analysts. So I just wanted to have a look through all the different resources that you can use to try and do your analysis. This video is sponsored by Genuine Impact, and I do have a link down below if you want a free trial of their premium features, but they do also have a free version of the app. So without further ado, let's just jump straight in. And the first stock we're going to look at is Royal Dutch Shell. Now, this originally surprised me because initially my thinking was, wait, aren't we kind of in a fuel crisis right now? But then I realized that it's actually a self-made crisis. It's not actually a petrol shortage. It is actually just a driver shortage. Duh. So obviously prices are going up, etc., etc. But there is lots more behind it. So let's jump in and have a look at Royal Dutch Shell. So let's have a look at tip ranks. So here you can see that the strong buy rating, as I mentioned, is from 13 ratings, of which 11 have said buy and 2 have said hold. And the price targets show an average potential 14% upside. So the lowest is lower than the current price, but the average and the high are pretty high. Now, if we look at when these came out, we can see that the last downside vote was actually 2 months ago, and all of the ones since have been a buy rating with some pretty decent potential upsides here. Now, if we have a look at the analysis here, the smart score is showing us 10, so that means it's forecast to outperform the S&P 500, and pretty much everything here is green. So the insider activity does seem to be trending towards buying shares, and we can see here actually it's all quite recent, so this is really good information to have as well. In terms of the news, we can see here that there are a lot of different views here, so a lot of positive and negative articles, which could sort of skew you a little bit depending on what you want to believe. But we've got here obviously all the oil prices down after hitting 3-year high, army on standby to deliver fuel, so that's obviously all that stuff that's going on in the UK. But then we've got things like low carbon deals and divesting assets, taking on new customers from bust suppliers. Obviously that's a huge one as well, because if they're going to take on suppliers from everyone that's going bust, well, obviously not everyone, but you know what I mean, that will give them a lot more income as well. They're investing 600 million in clean energy in Brazil, etc., etc. So let's have a look at Simply Wall Street, and this one is not looking quite as rosy. But if we have a look here, for example, at shares sold, they're actually not quite up to date, because we can see here that they've only got this transaction of selling, but that's back in July. Whereas if we go back to tip ranks and go back onto that insider selling one, we've got things from 2 days ago and 6 days ago and 20 days ago. So potentially just not quite up to date on this one. And this is partly why I like having multiple sources to review before trying to make a decision on whether to invest in something, because everyone's going to have a different opinion, right? So for one person this might be good, for someone else something else might be good, and also, as this illustrates, not everyone's information will be completely up to date. So just make sure you are using multiple platforms. I would never recommend to you, oh, just use this platform to do your research, and if I ever do, then I've sold out and you should probably stop following me at that point. But right now, you know, no matter which company I'm working with, I'm always going to recommend that you use multiple sources. So if we go into the valuation, so here it does suggest that Royal Dutch Shell is undervalued by almost 30%, which again goes back to those almost 30% upsides on tip ranks as well. Future growth here doesn't seem as high. It does seem like 2.2% forecasted annual earnings growth, which we can see here seems quite low compared to the industry and market. The earnings growth does seem to be quite negative over the last 5 years, but obviously that is also quite skewed by the last sort of year, as we can see here. And they've started to become profitable again in June this year. In terms of financial health, we can see that their assets outstrip liabilities both on short and long term. And they do pay a 2.9% dividend. So let's have a look at Genuine Impact next. If I head over to Discover and type in, can't spell, Royal Dutch Shell, and then let's just filter it so we're comparing it to the right sector. Okay, so we can see in comparison to the other energy stocks, they're not looking so bad. So quality 122 out of 341, value 26 out of 341, and momentum 103 out of 341. So not like top of the list, but pretty strong. And if we have a look at the checklist, that is a lot of green ticks. So we've got top 20% in value, ESG, which is interesting, share price stability, liquidity size, and expected growth. Now, with ESG, it is an interesting one. And if you haven't watched my live that I did with Charlotte on ethical investments, go check it out. I do talk about how different sort of ESG ratings can take into account different things. So it's not quite as clear cut as people think. Anyway, if we have a look at performance here, we can see here that in terms of US stock markets and global stock markets, in the last 3 months, we, as if I work for RDS, they have outperformed both, and same in terms of the last 1 year. Not so lucky for the last 3 years, however, or 5 or 10. So in the long term, they haven't really beat those two indexes, but in the last 1 year they have. So if we scroll down through all of this, we can see here that actually for ESG, they are ranked number 1 here out of all of these energy stocks, which is really interesting and potentially something to look into, because I want to try and do more ESG investing, and I always stayed away from RDS, so we'll see what's driving that. Dividend strength seems to be sound. It shows a minus dividend growth at the moment, but I think that they cut their dividend during the crisis, and I think they've just reintroduced it, so potentially that's what's skewing that one. Low historical growth and returns, but stable share price and high liquidity. Now, if we have a look finally at the analyst ratings on Genuine Impact, we can see here again 76% and 71% based on today and 30 days ago. It is majority buy, so almost 75% in the last 30 days have said it's currently a buy stock. None have said sell, and about 24 to 29 have said hold. So I'd love to know what you think about Shell, but let's have a look at the next stock on the list that analysts say is a strong buy, and that is Compass Group. So if you have been following me for a while, you know that I actually work part-time for the Compass Group. I haven't mentioned it a lot, but I do work for them in my 0 hours contract. So they are one of the biggest catering companies in the world, if not the biggest actually. But they are huge and they are great to work for. And if we have a look at the analysis, I think you'll agree with me that potentially this could be a buy. Obviously do your own research, but the analysts seem to think as a buy, and I've just topped up my position slightly in them as well. So as promised, strong buy rating here, 10 ratings of which 9 have said it's a strong buy, and the upside seems to be an average 11%, but the lowest price target we can see is actually higher than the current price. So it does seem like everyone seems to agree that it will increase in price. Now, the analysis here isn't as strong, but my thinking here is that because they are a hospitality company, they have actually been not really doing much, obviously, in the last 18 months. So, you know, this return on equity, asset growth, etc., obviously they've been making huge losses during everything being closed. So that potentially is skewing these figures a little bit. And providing everything stays open now, they should make a pretty decent comeback. Because if we have a look at the stock charts, they have come nowhere near yet to where they were before everything crashed in February, March. So you can see here they're like halfway through to where they were previously, which is probably where all of these price targets are coming from. So if we have a look at simply Wall Street, they seem to think that Compass Group is overvalued. But again, just highlighting the importance of looking at multiple sources. In terms of future growth, a pretty strong one here. So 33% forecasted annual earnings growth. So again, obviously you can see that huge drop in 2020. They went into the negative earnings here, minus 350 million, and then picking back up again from this year. Now, their short-term assets don't quite outstrip their short-term liabilities, but the long-term assets outstrip both. And they do pay a fairly small dividend, but I wouldn't see them as a dividend company. Okay, so let's have a look at genuine impact now. So if we filter on consumer discretionary, we can see there's 962 stocks in this category, and they're coming up quite low on these ones. So we can see here there's a few greens: ESG, share price stability, liquidity and size, but failing on historical growth. And again, this could go back to what's been happening during the last 18 months. So it is ranked number 49 on ESG rating, medium dividend strength, but it does seem to show low expected return and growth. But let's have a look again at these analyst ratings on genuine impact. So we've got half here, over half actually, 56% and 54% respectively, showing buy, and then about 40% saying hold, and then about 4 to 8% saying sell. So completely different from the ones we saw previously. So once again, worth having a look at multiple sources. So the final stock that analysts are currently saying is a really strong buy at the moment is Apple. So as you can see here, out of 25 ratings recently, so a lot of people submitting ratings for Apple, 19 are saying it's a buy rating. Average potential upside of 18% with the low price target lower than the current price. But if we have a look at all the price targets currently, we can see here that the latest show between 3 to 36% upside, and a couple have like 2% down, 3% down. But yeah, the majority show a pretty decent upside. In terms of the stock analysis, everything here is green. So Smart Score is 10, so they are forecast at the highest level to outperform the S&P 500. And you can see here, everything is green. So investor sentiment, blogger opinions, news sentiment, technicals, fundamentals, hedge fund activity, everything is green. So let's have a look at the Simply Wall Street now. So for Apple, we can see here that, again, not such a green snowflake here. Earnings have grown 9.6% per year over the past 5 years, but they have a high level of debt. So we can see here actually that their debt to equity ratio is huge. I mean, that to me as an accountant is just such a red flag. But obviously Apple stock and everything is just doing really well. So that just in my head struggles to compute. But yeah, that is a huge debt to equity ratio. And we've seen what's been happening with companies recently with high levels of debt. China. They have a very small dividend yield, but obviously Apple is considered a growth stock rather than a dividend stock, so that's not really surprising. And in terms of valuation, they seem to think that it's overvalued as well. But again, it's a growth stock, so that could be skewing this as well. So finally, let's have a look at genuine impact on Apple. So let's filter it on the IT sector. And out of 865 stocks, we can see here quality 165, value 565, and momentum 307. Now the checklist is looking pretty damn green. So quality, ESG, dividend strength, share price stability, liquidity size, growth, and accounting strength. So again, Simply Wall Street seems to be the very doom and gloom one, whereas Genuine Impact and Tiprank seem to be the more positive ones. But let's have a look. So performance-wise, you can see here over the last 10 years, it's 1,066% up versus the US and global stock markets of 348 and 217, and generally seems to consistently outperform both, with the exception of the last 12 months. So there we can see it was only 24%. So fairly interesting here. And if we jump down to ESG, again 49, which isn't too bad considering the amount of stocks here. Sound dividend strength, but again the dividend is tiny. And on the beat/missed consensus, they consistently beat their revenue and earnings per share targets. And in terms of analysts, once again, these ones are fairly large majority saying it's currently a buy. So almost 80% today and 81% in the last 30 days say currently buy, and about 20% saying hold. So obviously that's just a bit of a whistle-stop tour showing you the kinds of things that you can find out through these websites. You don't have to do all the analysis yourself. You can rely on other people to do it for you, but make sure you use multiple sources and then make your own decisions as well. Hopefully that's been an interesting video. Let me know what you think of these stocks. I love hearing what people think. Obviously, a lot of how a stock does is what people are thinking of it at the moment. So do you have any of these stocks? Are you going to buy any of these stocks? And yeah, that's it for today, and I'll see you next time. Bye.